stop for a moment, not because something might happen, because something already has and almost no one is paying attention yet. The most important signal in global finance right now isn't coming from Beijing, it isn't coming from Washington, and it isn't coming from a headline screaming crisis. It's coming from India. Quietly, deliberately, without drama, and that's exactly why it matters. For decades, global markets treated India as predictable. A growing economy, a neutral player, a responsible holder of U.S. Treasuries. India earned dollars through trade and recycled those dollars back into the safest asset in the world, American government debt. It wasn't exciting, it wasn't controversial, but it was stable. That stability is now changing. Not loudly, not aggressively, but structurally. Here's the key mistake most people make when they analyze bond markets. They listen to speeches instead of watching flows. Because speeches are cheap, flows are expensive. When a central bank buys treasuries, it's not chasing yield. It's buying into a system. It's saying, I trust your courts, your clearing systems, your rules, and your politics. When a central bank sells treasuries, especially when yields are high, it's saying something very different. And that's exactly what India has begun to do. U.S. Treasury yields are not low right now. They're high enough that, historically, foreign central banks rush in to lock them. This is textbook behavior. You buy yield when it's offered. You don't walk away from it. India is walking away. And India doesn't panic sell. It doesn't speculate. It doesn't react emotionally. The Reserve Bank of India operates like an engineer, not a trader. Slow decisions, long horizons, conservative risk management, which makes the direction of this move far more important than the speed. So the real question isn't how much India sold. It's why a country like India would sell it all. And the answer has almost nothing to do with price. It has everything to do with risk. Not interest rate risk, not duration risk, not volatility risk, jurisdiction risk. Because after 2022, the definition of safe reserves changed permanently. When Western governments froze hundreds of billions of dollars of Russian sovereign assets, it wasn't just punishment. It was a demonstration, a proof of concept. It showed that reserves are only yours as long as the system allows them to be. From that moment on, every central bank had to confront a question they hadn't taken seriously before. What happens if my assets are legally untouchable but politically inaccessible? Now think like India. India is not aligned to one bloc. It buys oil where it's cheapest, weapons where they're best, technology where it's most advanced. India's entire strategy is autonomy. But autonomy becomes fragile when your national savings sit inside another country's legal system. Because the risk isn't that the U.S. can't pay. The risk is that the U.S. decides you're a problem. And in a world moving toward sharper sanctions, payment restrictions, and geopolitical pressure, that risk is no longer theoretical. At this point in the story, let me pause and ask you something important, because how you answer this tells me how you see the world changing. If a country like India, stable, growing, and not under financial stress, starts quietly reducing exposure to U.S. debt, do you think that's a routine portfolio adjustment or a signal that the rules of the global system are shifting? Drop your view in the comments. And if you want calm, evidence-based breakdowns like this before they turn into headlines, make sure you're subscribed. Now let's go one layer deeper, because here's where this stops being theory and starts becoming structural. India is not selling treasuries because it needs dollars. India's foreign exchange reserves are near historic highs. Its currency has not collapsed. There's no emergency here. This is not a liquidity event. That matters because it tells you this move is driven by choice, not necessity. And when a central bank acts from a position of strength, you should pay attention. Central banks don't sell reserve assets unless they already know what they're replacing them with. They rotate. And rotations reveal intent. So, if India is reducing treasuries, the most important question becomes, what asset do they trust more than U.S. government debt? Because central banks have strict rules. They don't chase returns, they don't speculate, they don't buy assets that depend on political permission. The replacement has to meet 3 conditions. It must be globally trusted, it must be liquid at scale, and it must minimize counterparty and jurisdiction risk. There's only one asset that meets all 3. Gold. But not just gold as an accounting entry. Not gold held in someone else's vault. Physical gold. under sovereign control. This is where the story shifts from markets to movement. Because when a country decides that counterparty risk has become unacceptable, it doesn't just change allocations on a spreadsheet, it changes custody, it changes location, it changes who controls the asset in a worst-case scenario. And India's actions over the past 2 years point in one direction, away from paper promises and toward physical sovereignty. This is not a bet on gold prices going up next month. This is insurance against a world where access matters more than yield. And once you see that, India's Treasury reduction stops looking like a trade and starts looking like preparation. Preparation for a system where trust is conditional, where reserves must be politically neutral, where control matters more than convenience. And this is only the first layer. Because selling treasuries is the easy part. The harder and far more revealing move is what India has been doing with its gold. And that's where the real signal begins to emerge. What separates a routine reserve adjustment from a strategic shift isn't what a country sells, it's what it moves. Because selling treasuries is reversible, moving gold is not. Once physical assets change location, intent becomes permanent. This is where India's actions move from interesting to unmistakable. For decades, a significant portion of India's gold reserves sat outside the country. Not because India didn't value gold, quite the opposite. Gold has always been central to India's financial psychology, but the post-Cold War system rewarded convenience. Gold stored in London could be leased, swapped, mobilized instantly inside Western financial plumbing. It was efficient, it was liquid, it fit neatly into the rules of globalization. But efficiency only works when trust is absolute. Once trust becomes conditional, efficiency turns into exposure. After 2022, central banks around the world were forced to confront an uncomfortable truth. Reserves are only safe if they remain accessible during political stress. And accessibility is not guaranteed when your assets sit inside someone else's jurisdiction. India understood this immediately. And instead of debating it publicly, it acted quietly. Over a series of tightly coordinated operations, India began repatriating gold. Not ceremonial quantities, not symbolic gestures. Large, deliberate shipments, aircraft, security protocols, expanded domestic vault capacity. This wasn't about making a statement. It was about removing a vulnerability before it became obvious. Because gold held abroad is a financial asset. Gold held at home is a sovereign asset. That distinction matters more than price. Gold stored in foreign vaults exists inside someone else's legal framework. It can be leased. It can be rehypothecated. And in extreme scenarios, it can be frozen or restricted. Gold held domestically answers to no foreign court. It cannot be digitally blocked. It cannot be rendered inaccessible by a policy decision made thousands of miles away. When India chose to move gold home, it wasn't expressing optimism about precious metals. It was expressing skepticism about the system. This is the first new consequence. Control replaced yield as the primary objective. At the same time, India was reducing exposure to U.S. Treasuries. It was increasing exposure to assets that do not rely on trust in foreign institutions. This wasn't a rotation into another Western asset. It wasn't a search for better returns. It was a conversion from paper claims to physical control. And that tells you exactly how India views the next phase of the global system. Not as a smooth evolution, not as a managed transition, but as an environment where access cannot be assumed. Now here's the critical point most commentary misses. India is not in crisis. Its foreign exchange reserves are large. Its growth is strong. Its currency has faced volatility at times, but it is not collapsing. This means these decisions are being made from a position of strength, not desperation. That matters because countries acting under stress react to today's problems. Countries acting from strength prepare for tomorrow's constraints. India is preparing, and what it's preparing for is not a specific event, but a category of risk. Jurisdictional risk, sanctions risk, payment rail risk. These risks don't show up on yield curves. They show up when assets become inaccessible precisely when they're needed most. That's why gold's role here is so important. Gold is not just a store of value, it is a settlement asset that exists outside digital permission systems. It can move across borders without relying on SWIFT. It can be used when currencies fragment. It functions when trust breaks down, which explains why India's move didn't stop at repatriation. At the same time, India has been quietly expanding alternative settlement mechanisms, rupee-based trade agreements, bilateral clearing arrangements, payment rails that bypass traditional Western channels. These systems are not meant to replace the dollar overnight. They are meant to reduce dependency gradually. This is the second consequence. Redundancy is replacing efficiency. In engineering, redundancy isn't pessimism. It's good design. You don't build backup systems because you expect failure tomorrow. You build them because failure eventually happens. India is building backups. And backup systems change behavior long before they change headlines. When reserves become diversified away from treasuries, the automatic bid for U.S. debt weakens. Not dramatically, not all at once, but incrementally, quietly, invisibly until it isn't. This is where India's role becomes uniquely important. India is large enough to matter, but neutral enough to be copied. When China sells treasuries, markets frame it as confrontation. When India sells, markets frame it as prudence. That makes India's behavior contagious, because India becomes the proof of concept that you can grow, trade globally, and still reduce reliance on U.S. debt without declaring economic war on the system. This introduces a new dynamic. If the fastest-growing major economy in the world no longer treats treasuries as the default destination for reserves, the funding model that relied on emerging markets recycling surplus dollars begins to weaken. And when that happens, the burden doesn't disappear. It shifts. Either yields must rise to attract private capital, or leverage must increase to absorb supply, or the central bank must step in. None of those options are neutral. Sovereign buyers anchor markets. They buy patiently. They absorb volatility. Leveraged buyers amplify stress. They sell when conditions tighten. Central banks can absorb unlimited supply, but only by expanding balance sheets. India understands this math, which is why its strategy isn't loud. It's preemptive. By converting part of its reserves into physical assets under domestic control, India is insulating itself from a future where paper claims become more volatile, more politicized, and more dependent on central bank intervention. That insulation comes at a cost. Gold doesn't pay yield. Physical custody is inconvenient. Repatriation is expensive, but that cost buys optionality. Optionality means you don't have to react under pressure. You don't have to accept terms dictated by others. You don't have to liquidate assets at the worst possible moment just to regain access. And that is what central banks are optimizing for now, not return, but resilience. Once that mindset spreads, behavior everywhere begins to change. Currencies fragment. Trade becomes more bilateral. Reserve strategies diversify. Liquidity becomes less predictable. This is not deglobalization in the dramatic sense. It's de-risking, a slow, methodical move away from single points of failure. India is not exiting the global system. It is preparing to operate inside it with fewer vulnerabilities. And that distinction matters, because the next phase of this transition won't look like collapse. It will look like friction, higher volatility, wider spreads, more frequent interventions, sudden repricings that feel disconnected from narratives, moments where markets feel stable until they don't. And in those moments, the difference between paper wealth and real control becomes very clear, very fast. This is why watching movement matters more than watching headlines. When gold moves physically, that's intent. When custody changes, that's preparation. When treasuries are sold quietly, that's positioning. Those signals appear long before consensus forms. By the time mainstream discussion catches up, the architecture has already shifted. India's actions are not isolated, they are part of a broader pattern. Other countries are watching, some will follow carefully, some will wait too long, but the precedent has been set. You can grow without doubling down on dollar exposure. You can trade globally without trusting one jurisdiction completely. You can hold reserves that don't require permission, and that realization changes the system whether headlines acknowledge it or not. Because once reserve behavior changes, everything downstream must adjust. And that brings us to the final layer of this story: what happens when enough countries quietly make the same calculation, and why that moment reshapes the financial system for everyone inside it. When enough countries quietly reach the same conclusion, the system doesn't collapse, it reconfigures. And reconfigurations are far more disruptive than crashes, because they happen while everything still looks functional on the surface. For decades, the global financial system operated on a simple loop. The United States consumed more than it produced. The rest of the world ran trade surpluses. Dollars flowed outward through deficits and then flowed back inward through U.S. Treasuries. That recycling kept yields low, funded deficits cheaply, and stabilized currencies across the developing world. It wasn't perfect, but it worked because trust worked. What India is signaling now is that trust alone is no longer sufficient as a foundation. When a large, growing economy begins treating U.S. Treasuries as a conditional asset instead of a permanent reserve, the loop weakens. And when the loop weakens, pressure doesn't disappear, it concentrates. The first place that pressure shows up is demand. U.S. debt issuance is not slowing. Deficits are structural. Interest expense is compounding. Social spending and defense spending are embedded. Trillions in new paper must be absorbed every year, regardless of market sentiment. If long-term sovereign buyers quietly step back, the system has only three alternatives: private capital, leverage, or the central bank. Private capital demands higher yields and is quick to leave when volatility rises. Leverage amplifies stability until it suddenly amplifies stress. Central bank absorption stabilizes markets, but at the cost of balance sheet expansion and currency dilution. None of these are neutral substitutions for patient sovereign demand. This is why India's move matters far beyond its own portfolio. India is not big enough to replace China as a singular force, but it is big enough to normalize behavior. When China exits, markets frame it as conflict. When India exits, markets frame it as prudence. That distinction is critical. India becomes the template other emerging economies can point to when they want to reduce exposure without looking adversarial. Quiet diversification becomes defensible. Gradual reallocation becomes acceptable. The idea that growth must automatically subsidize U.S. deficits begins to fade. And once that assumption weakens, the global system must adjust. That adjustment doesn't arrive as a single event. It arrives as friction. Volatility becomes more frequent. Liquidity becomes more episodic. Spreads widen faster during stress. Interventions become more common. Markets still function, but with less tolerance for surprise. This is why the shift matters for everyone, not just policymakers. When reserve behavior changes, it affects currency stability, interest rates, capital flows, and risk pricing everywhere. It reshapes the environment investors operate in, whether they recognize it or not. And this is where the deeper lesson emerges. Central banks don't optimize for profit. They optimize for survivability. They ask different questions than most investors. What becomes inaccessible under stress? What assets remain liquid when systems fragment? What still works when trust is conditional? India's actions tell you how those questions are being answered. Paper claims are becoming less attractive. Physical control is becoming more valuable. Optionality is being prioritized over yield. That doesn't mean the dollar disappears. It doesn't mean treasuries become worthless. It means the world is becoming more selective about where it parks its safety. And selectivity changes behavior long before it changes headlines. This transition will not be smooth, not because of panic, but because the system was built for efficiency, not redundancy. As redundancy is introduced, costs rise, liquidity thins, adjustments become sharper. The era of effortless recycling is ending. The era of negotiated balance is beginning. India is positioning for that world, not by predicting collapse, but by preparing for uncertainty. Preparation always looks unnecessary at first, cautious, conservative, even wrong, until suddenly it isn't. That's why following behavior matters more than following narratives. Central banks don't always get direction right, but they are usually early when structure changes, and structure determines who has options and who doesn't. India's quiet exit isn't loud. It isn't dramatic. It doesn't come with emergency speeches or countdown clocks. It comes with spreadsheets, logistics, custody changes, and slow reallocations. That's how real shifts happen. Not overnight, not all at once, but decisively. If this breakdown helped you understand why this move matters, not just what happened, make sure you're subscribed. These transitions don't come often, but when they do, understanding them early is the difference between reacting and adapting. And share your thoughts in the comments. Do you think this quiet exit stays contained, or is it the first visible crack in a much larger transformation?